The tariffs have hit. The stock market went crazy, judging by all of the red that you see here on Monday. What's going to happen with mortgage rates? Here we've got Tracey with Assurance Financial. Almost had a big old, got a blooper right now, and we're just going to keep on rolling because look, that's how live video works. So Tracey with Hancock Whitney. You'd think I'd know that after about like a year and a half. Anyway, Tracey, so we had a crazy day going on in the stock market. Everybody usually thinks that when stock markets go down, so do interest rates, and they didn't. So what happened?
Yeah, so typically whenever bad things happen, negative things happen in the market or around the world, investors find bonds to be a safe haven for money. And so then typically money will flow out of stocks and flow into bonds. However, that's not what's happening right now. And when money does flow from stocks into bonds, bonds are what back mortgage rates. So then mortgage rates drop, but that didn't happen.
Gotcha. So lots of, typically we kind of see that, but this one we did not.
We did not see that. So everyone expects that, the stock market, opened really poorly yesterday morning. So rates should be really good. And where we did see rates start to improve towards the end of last week, rates definitely did not plummet. And actually Monday, and I would expect today when the market opens, that it's a little bit worse than it was on Thursday and Friday of last week because money did not flow into bonds as it typically does.
We'd love to be able to see some of that, to be able to make that work, but we're not seeing them skyrocket. They're just kind of hanging out.
No, but they didn't plummet like they typically do. So there are a lot of inflation concerns. There's a lot of concerns about where do I invest my money? Do I hold on to my cash instead of investing it into bonds? So right now, everybody's just a little timid when it comes to investing their money or moving it around.
And one thing that seems to be fairly consistent is we kind of live in a knee-jerk reaction economy, meaning, we see something, oh my God, we got to sell, or oh my God, we got to buy. And, moments in history when it comes to both stock market as well as the real estate market are just moments.
If you're looking at hindsight, it's already done.
Right. It's here, it's gone, it's going to be a blip. It's going to be a distant memory. So I think reacting to things whenever it comes to what's happening inside the marketplace, just because of a singular event, doesn't necessarily mean you need to make a knee-jerk reaction right now.
Right. And also, like I said, don't assume that rates have dropped tremendously, or don't expect rates to be half a point to a point lower just because of the stock market reaction this week.
Sure. So forecasting, best advice I could always give folks is plan for what's going on with today's world.
Right.
At some point we could potentially hopefully see rates drop, but that's definitely not something that's going to be happening immediately, like some of the news folks typically.
Yeah, the market's interest rate market is a little bit volatile, not tremendously volatile. I would say right now, if you're under contract or if you're refinancing and you're ready to move forward, I'm advising my clients to lock the rates. Now it's their decision in the end, but lock it because, what we saw Monday was a little worse than what we saw Thursday and Friday. So you hate to regret missing those lower rate opportunities just for waiting.
Gotcha. And look, typically what happens, whatever we're looking for, when's the right time to buy? If you're not currently under contract right now, when's the right time to buy? When's the right time to sell? Or the right time to buy is when you're ready. Timing the market, like to go on the top end is like trying to be able to catch a basketball at the very top or catching a falling knife if you're looking for a stock market analysis. It just doesn't work. You're going to catch it on the way up. You're going to catch it on the way down.
Right.
It's just, in the long run, real estate is a long-term game. It's not something that you turn around for most folks. You're not buying anything to turn around and sell it in 3 months. As much as I'd love to see you guys do that, go buy and sell things every 3 months to go move into places, that's just not realistic. So it's a long-term play. typically we see our folks in here from 3 to 5 years. Your market stuff's still safe. So
yeah, and typically whenever it comes to mortgage rates, your government pricing has the tendency of being a little bit better than your conventional pricing. So government pricing would be FHA, RD, and VA. But just keep in mind that those products come with either mortgage insurance that can be sometimes a little bit higher, or upfront mortgage insurance that's financed into the mortgage, or both. Whereas with conventional, the rate may be a little bit higher, but with 20% equity, you either negate the need for PMI mortgage insurance, or it drops once you reach 20% in equity. You just have to figure out what's the trade-off and which product makes more sense for you. Is it the lower rate, or is it the lower or non-existent mortgage insurance?
And of course, everybody's financial situation is going to be a little bit
Everyone
different.
is different.
Rumor has it that, you know, I've actually seen some potential spots where you see below 6% on government rates. I don't know. The best way to be able to find out is to call Tracey.
Yeah.
And where can they find you?
Tracy.lacer@hancockwhitney.com.
Awesome. Well, we'll see you guys. But before we go, one more quick thing, just to kind of reiterate, the best time to be able to buy is when you are ready. And we will see you guys next week.